In 2015, we've delivered a solid full-year performance. The organic performance improved and our earnings were slightly ahead of market expectations. In 2015, the group generated revenues of £2.2 billion. At actual currency, this is a growth of 3.5%. The organic growth momentum improved during the year. The full-year organic growth was 1.6%. Adjusted operating profit was up 5.9% at actual currency. The group adjusted operating margin was 15.9%, an increase of 40 basis points at actual currency. We have delivered a full-year adjusted EPS of 140.7p, which was up 6.5% at actual currency. I'm pleased to report a proposed increase in the full-year dividend to 52.3p, up 6.5% compared to 2014, in line with our progressive dividend policy. The improvement of our organic growth performance has been broad-based. The Consumer Goods division continued to deliver good growth with a year-on-year increase of 4.4% at constant currency. We benefited from strong growth in soft lines and solid growth in hard lines. The Commercial and Electrical division reported organic growth of 6.1%, benefiting from strong growth in transportation technologies and building products, while our Electrical and Wireless division continued to deliver good growth. The Chemical and Pharma division delivered a strong organic growth of 5.5%, benefiting from increased R&D developments in health and beauty, as well as from strong growth in regulatory assurance. In the Commodities division, good organic growth of 3.8% was driven by improvement in both our Cargo AA and Government Trade Services businesses. Performance in the Industry and Assurance division was mixed, with strong growth in the agriculture, food and business assurance businesses, while trading conditions in industry services remain challenging. Margin management is an important priority. We have delivered a 20 basis point margin improvement at constant currency, driven by a robust performance in our product and trade-related businesses. Our Consumer Goods division margin remained stable at 33.7%. The benefit of positive operating leverage driven by organic growth was offset by investment in growth areas. In the Commercial and Electrical division, we benefited from productivity gains in the second half, driven by strong revenue growth, resulting in a full-year margin increase of 50 basis points. Margins in Chemical and Pharma improved by 130 basis points, and the margin in Commodities improved by 220 basis points. Both businesses benefited from the 2014 restructuring activities and positive operating leverage driven by good growth. The margin in Industry and Assurance declined by 260 basis points, in line with our expectations. Margin growth in the food, agriculture and business assurance businesses was more than offset by margin decline in industry services. Given the challenging trading conditions in the global oil and gas industry, we have taken a non-cash impairment charge to reflect these uncertainties. This one-off charge had a material impact on our reported profits, but does not impact the solid underlying performance of the business. Cash management is also an important priority. In 2015, the cash generated from operations was $466 million. That was up 15.4% year-on-year. Our cash conversion at 136% was strong. Turning now to the outlook. In 2016, we expect to deliver a solid organic growth performance. Our products and trade-related businesses should benefit from a good growth momentum, which will be partially offset by the continuation of challenging trading conditions in our industry services businesses. We will integrate PSI in our US business and execute our Year 1 synergy plans. From a profitability standpoint, we will remain disciplined on cost and expect our margin to be broadly stable year-on-year. We'll continue to invest in growth, and we expect our full-year capex investment to be circa 100 to 110 million pounds. We'll remain focused on cash and maintain our disciplined approach to capital allocation. We should end up the year with a net debt of circa 650 to 700 million pounds. This does not include any acquisitions we might make during the year. In summary, the group delivered an improved revenue and profit performance in 2015. Driven by a strong performance of our product and trade-related businesses, which represent 90% of the group operating profit. Cash conversion remains strong, and we have invested in growth with a disciplined approach to capital allocation, targeting investments in business and countries with good growth and good margin prospects. The growth opportunities moving forward are very attractive, and we are well positioned to benefit from the GDP plus organic growth prospects of the industry in the medium to long term.